Welcome back to Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to be reviewing some fresh economic data as well as some stock market updates. A recent poll by The Guardian revealed that 56% of Americans believe we are in an economic recession. We are not in an economic recession, but there is definitely an economic disconnect from the masses. And I think what consumers are really trying to say is that they are feeling the effects of inflation. And we haven't had inflation at these levels since the late 70s, early 80s. So most adults like myself have never experienced inflation firsthand. To be fair, inflation was not nearly at the levels that we're experiencing now. They were, in fact, much higher. In the time period through 1977 to 1982, it was known as the Great Inflation Period, and we saw inflation exceeding 14%. The highest we experienced during this high inflationary period was 9%. We did just receive fresh GDP data. We've talked about GDP multiple times on this podcast, but as a reminder, GDP stands for Gross Domestic Product, and it is a monetary measure of the market value of all the final goods and services produced and rendered in a specific time period by a country or countries. GDP is often used to measure the economic health of a country or region. Basically, GDP is measuring the monetary growth of a country by the full cycle of product production and consumers purchasing said product or service. Historically, the way we have measured a recession is by the decline of GDP for 2 consecutive quarters. I say historically because I do think it's important to highlight that this is the way we've always measured a recession. However, when Biden took office, we did experience a short recession by technical definition, and he held a press conference to say that we not only have to account for 2 quarters of declining GDP, but we also have to consider an unemployment rate. At the time of this recession, our unemployment rate was in fact really low. I took a look at the data historically with our last really big recession in 2008, and during that time, we did in fact have a really high unemployment rate. I can see why it's important to also take job loss into consideration. However, it has never been used as a barometer to measure a recession. It just so happens that anytime there is a recession, there's typically a high increase in unemployment. I say all of this to say that we are truly moving through a unique economic period. Rules are being rewritten. We're having to take different circumstances into consideration. It's also worth noting that no president wants a recession during their term. And so the debate continues to be, do we take unemployment into consideration when we are determining a recession, or do we hold true to the original rule that consists of 2 declining quarters of GDP? We just received fresh GDP data. Analysts were expecting our GDP to increase by 1.6%. Unfortunately, we came in short of that at 1.3%. We also had declining numbers in April, where analysts were expecting a 2.5% growth in our GDP, and we came in at 1.6%. While I do think that this data could spark a conversation surrounding the idea that we can be headed towards a recession, jobless claims are looking really low. And so if we take into consideration jobless claims like President Biden has asked us to, then it doesn't look like we would be headed towards a recession. I do think that this does beg the question, then what exactly is shrinking GDP telling us if it is not telling us that we are moving towards a recession because of low unemployment rates? And I also think it's worth looking into why unemployment rates are so low during a economic period that is extremely tough, also during a period where we're witnessing so many layoffs. There's just so much contradicting information. We're going to take a short break, and when we get back, we are going to get into stock market updates. And we're back. Last week, I talked to you about Target discounting prices on over 5,000 items. And I also mentioned that I thought that this was an important trend that we are potentially going to see emerging in other retailers because we have to stay competitive. I also think that this can truly lead to deflation. It's important for us to understand that as we watch the inflation numbers come down, we understand that we're experiencing disinflation, which is the decrease in the rate of inflation. And deflation is the decrease in the general price level. We have not yet experienced deflation. We have not yet experienced the prices of items come down. And now that we have these retailers reporting that they are going to begin cutting prices, I think this is going to lead us to the path of experiencing deflation. We have Walgreens that just recently announced that they will be cutting prices on more than 1,300 items as a part of its summer savings. We also have Amazon Fresh that has announced that they will be discounting the prices of 4,000 items in both name brands and its own brand products. Walmart is going to start cutting prices on nearly 7,000 products across food categories. And we have Aldi that announced that they will be cutting prices on more than 250 items, including meat, frozen foods, and snacks. Now, as a reminder, we talked about this in last week's episode. These prices are being cut because of the weakness that the consumer is showing. In other words, they have no choice but to begin lowering the pricing on their products. We are seeing the same trend appear in real estate. Pending home sales in April slumped to the lowest level since the start of the pandemic. This has resulted in sellers cutting their prices. We've seen 6.4% of sellers cutting their prices in the month of May, and this has been the highest level we've seen since 2022. I think it's really safe to assume that all of these numbers that we're reporting in terms of price cuts will result in lower inflation. I haven't seen any analysts talk about it yet. I think it's definitely forward-looking, meaning that we won't see the result of these price cuts until potentially another 2 months. But I definitely see how we're headed in that direction. And ultimately, this is really good for our lower income consumer that is struggling to just keep up with day-to-day expenses. Moving on to the overall look of the stock market, I think it's important to highlight that while we have had a relatively rough week this week in the market, overall for the month of June, we are closing relatively strong. I want to share those numbers with you and also share a year to date so that you can gain some perspective on how well the stock market is performing despite all of these other numbers that are feeding us negative news. The S&P 500 for the month, as of right now, as of recording this on Thursday, is up 4.68%. Now, just as a reminder, on average, the S&P 500 is expected to grow anywhere from 8 to 10%. So for it to be at 4.6% for the month of June is pretty freaking good. Year to date, the S&P 500 is up 10.81%. And so we can see that almost half of its growth was acquired in the month of June. It's honestly no wonder that we're having a pretty rough week. This is merited. We want the stock market to take some breaks. The Dow is up for the month 0.79%. And year to date, it is up 1.19%. Now, the Dow typically has a lower average than the S&P and the NASDAQ. Now, let's take a look at the NASDAQ. For the month of June, we are up 7.62%. And year to date, the NASDAQ is up 14.10%. Typically, when we are reviewing the stock market here on Investies, I normally just give you the average of the 3 top indexes. I thought it would be fun today if I went ahead and pulled some common household names so that you can actually see the growth of individual stocks versus just an average in an index. First up, we have Walmart, coming in at 9% growth for the month of June. Year to date, Walmart has grown 22%. Apple struggled for a while in the beginning of the year. It saw low sales in China, so a lot of its numbers there were affected. In the month of June, it grew 10%, but when we look at it year to date, it has only grown 3.44%. So June was a lot about recovery for Apple. Amazon has grown 4% in the month of June. Year to date, we are looking at a 20% increase. Google has grown 5% in the month of June and 25% year to date. And then we have Netflix coming in at 17% in the month of June, and with a year-to-date growth of 38%. The stock market is performing extremely well, and historically, over the years, we know that the stock market performs well. Of course, it has its years where it declines, which, as we know already, those are really great opportunities to build our portfolios. This is why it is so important for us to take advantage of the stock market. It is time for us to begin participating. This should no longer only be exclusive to the top 10%. We should also be using this as a vehicle to build generational wealth. And let's not even get into the economic education that just by participating in the stock market begins to give you over time. 56% of Americans believe we are in a recession. This is because of their lack of knowledge and understanding on a system that controls us. At the end of the day, we need money to pay our bills and put a roof over our head. If we don't understand how the system works, we will never be able to use it in our favor. You're listening to Investies, a Cosmic Standard and In Luz We Trust production. I'm your host, Linda Garcia. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.